Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 5th of June. I'm Daniel Lam, your host for the podcast. We see a developing trend that the US fiscal dynamics are becoming increasingly unsustainable. That raises concerns about fiscal dominance, i.e. the monetization of government debt by the Fed. Now, the Congressional Budget Office, CBO, projects that the fiscal deficit will remain wider than 5% of GDP through 2034, with unproductive interest costs accounting for roughly two-thirds of the deficit by then. Now, this projection could be optimistic, as it assumes discretionary government spending at 60-year low as a share of GDP over the next decade. Now, the risk is that fiscal spending is now structurally higher due to items such as increasingly defense spending, the green transition, and infrastructure improvements. Neither Biden nor Trump has offered any real fiscal deficit reduction plan ahead of the elections. Also, the moderate voices in both parties that typically help to make bipartisan agreements have been weakening. The US status as the world's leading economy has allowed its deteriorating fiscal position to go largely unpunished by markets so far. But policy uncertainties and potential fresh trade wars under a new administration could cause foreign investors to withdraw from the US bond markets even as supply continues to rise. Now, we've all seen the very muted demand reaction for the US Treasury auction last week. We can see these kind of tepid demand more often going forward. So yield levels would need to be higher to induce foreign buying. But then, as we noted above, this would add pressure to the already high interest costs that may potentially take up two-thirds of the fiscal deficit. Could this be the reason why the Fed kept talking about rate cuts, when the US macro conditions do not really warrant a much aggressive rate cut actions? So the endgame is that the Fed could be forced to buy the debt, moving the US into fiscal dominance. Now, this would lend support to fixed income initially, but negative for the government's fiscal condition for the long run. Now, gelling with what we discussed yesterday regarding the undocumented workers, so there are forces to drive yields down in the second half of this year, and room for fixed income to catch up in some performance then. So watch out for that and stay balanced in your allocation. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.